Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. The Karnataka government announces a new startup policy seeking to add 10,000 startups over the next 5 years, aims to establish 50 new age innovation centers outside the startup capital Bengaluru, to set up a 100 crore fund to back startups across AI, EV, robotics, drones and more.
Flipkart and PhonePe complete their separation and both the Walmart-owned companies will now operate independently. This also completes the move to make PhonePe an India-domiciled company. Employees set for a windfall payout as Flipkart announces $700 million cash payout on ESOPs.
Google approaches the NCLAT challenging monopoly watchdog CCI's directive to pay a penalty of 1,337 crore rupees, seeking a stay on the order. Google claims the decision could be a major setback for Android users in India, saying that it could raise the cost of Android devices.
Facebook moves to put the Cambridge Analytica case behind it. Owner Meta agrees to pay $725 million to settle the class action suit. But Meta does not admit to any wrongdoing in the matter, says the settlement is in the best interest of its shareholders.
Former FTX boss Sam Bankman-Fried is released on bail after he posts a personal bond for $250 million. He will be kept under house arrest at his parents' home in Palo Alto as he awaits trial for 8 federal criminal charges.
Data science and AI startup Tridence raises $175 million in Series B funding, led by Advent International, which joins the startup's board with a minority stake. With fresh funding, the Bengaluru and San Jose-based startup aims to become a $500 million revenue company.
Well, those are the headlines we've been tracking for you this evening. Global market intelligence platform Traction recently released its Traction Geo annual report, India Tech 2022. Now, the report provides a detailed overview of the Indian startup ecosystem by delineating funding activities, investor exits through acquisitions and IPOs, and wider trends in the fundraising landscape. To elaborate on the key highlights of the report, joining me now is Traction's co-founder, Neha Singh. Also joining me is my colleague, Arundhati. Neha, welcome to Startup Street. Now, 2021 was a record year in terms of funding. It was a boom year for startups and VCs. While 2022 started off with a bang, the amount of capital and funding rounds started dwindling. Your report shows that the number of funding rounds has seen a drop of 30% compared to last year. Neha, what led to this significant drop in funding, and by when do you see the funding winter getting over?
Thanks so much, firstly, for having me. So yes, as you see in the stats, this year was fairly slow as compared to last year. So both the funding was down 35%. Number of rounds was down 30% as compared to 2021. The decline had started happening from Q4 of 2021, which is in line of when you saw the decline also happening in the public markets. And across all the quarters, you saw the numbers actually keep coming down. And that's one of the reasons why, because of the interest rate, what impacted the public markets, you also saw that impact in the private markets. And coming to the second question, which is, when is has it bottomed out, and how does the outlook look like? So there are good early signs. So if you actually look at the Q4 data, it looks like, across all the quarters, the decline was continue to happen. And Q4 looks to be flat, like in line of, slightly more than what the funding had happened in Q3. So there are some early signs that it looks like the decline has stopped and probably it has bottomed out. Most likely it is going to be sideways for a few more quarters, but you still have to wait and watch and see if any macro new situation is going to emerge, which might impact this. But it there are good early signs that it looks like the decline has sort of stopped, but it'll probably be muted for the next few quarters.
Okay, all right, good to hear that, Neha. But one of the key highlights also is that seed stage funding, despite seeing some amount of contraction versus the previous year, did better than late stage funding. What was the reason for this, and will we see seed stage funding grow even more in 2023?
So that is correct. If you compare the seed stage versus the late stage, in the late stage, you saw the impact to be more severe. So the late stage was down 45%, and that is also reflected in the number of late stage rounds, number of unicorns rounds. They were much lower than last year. And one of the reasons is, if you look at it in India, most of the late stage is actually done by global investors, which have exposure to also other countries outside India. Some of them are also crossover funds, which have exposure to the public markets in addition to the private markets. And if you look at the global sentiment, say the sentiment in US, that is more muted than you would see in India. Like you can also see it in US, a lot of people are still talking about a recession next year, while in India, that percentage is much lesser. And even in public markets, if you look at it, Nasdaq is down, whereas Nifty is probably flat YTD. So that is one of the reasons that in the late stage you saw the impact to be more than the early stage. In the early stage, you have more domestic funds which continue to sort of invest. Obviously, they are investing at a much slower pace than what they were investing last year, but they still continue to do deals even despite the slowdown that has happened in this year.
All right. Hi Neha, Arundhati here. Let's get sector specific then. According to your report, enterprise applications, fintech and retail were the top performing sectors in terms of funding this year. So what's exciting about these sectors? Will this trend continue? Also, what do you think will be the hot sectors for 2023?
So that's correct. So there were some sectors which were more resilient than the others in this year. And I think in this year, there's also interesting things that you see. There are a lot more new areas that you saw funding happen despite the slowdown which is happening. For instance, fintech is one sector which continues to sort of perform. Very interesting sector, space tech, for instance, India launched its first private rocket this year. And you saw multiple companies come up and scale in this area of space tech. Even agri-tech saw companies sort of scale. EV continues to be one area of focus as well. So there are these sectors which we think will continue to sort of be exciting for investors in the next year as well.
Okay, so those are the ones that are going to be exciting next year as well. But let's talk about the big edtech sector, which saw a massive boost in 2020 now. But lately in 2022, it's been faltering. We've seen so many layoffs out there. What does the sector need to do to see that kind of growth again? What's the outlook for the edtech sector going forward?
So that's correct. EdTech is probably one of the worst hit sectors. This was also one of the sectors which had seen disproportional acceleration during COVID. And you saw a lot of companies had to do overhiring just to keep up with the increased demand that had happened during the COVID time. Now with the schools reopening, I think two things have happened. One is the new acquisition has slowed down, as well as some of the existing customers which had opted for an online method of education has now moved back to the offline channels. So because of this, you also saw a lot, this impact in the companies, and hence the companies had to do a layoff to, continue to remain sort of in the right trajectory. But even within EdTech, we do see there are some sectors which were more resilient. For instance, if you look at corporate learning or continued learning, or anyone who is helping the offline system of education, like education loan companies, etc., they continue to sort of grow throughout this period as well.
Okay, all right. Perhaps we might even see more consolidation going forward in the edtech sector. But Neha, according to your report, 22 startups entered the Unicorn Club this year compared to 46 in the previous year. Investors' evaluation metrics now emphasize good profitability over growth at all costs. Tell me, will startups continue to establish clearer and more sustainable paths to grow? Is that the way forward? Also, will we see a rise in the number of unicorns next year?
So that is correct. The number of unicorn rounds were nearly half of what it was last year. And, this year you saw the late stage investors asking the companies more about the path to profitability, clear visibility on when is the likelihood that they will become profitable. And you also saw companies talk about it, that they plan to become profitable in so much, in so many years or in months. So yes, I think that the unicorn funding rounds will probably remain muted even the next year, because of the same fact that a lot of these were led by global investors like Tiger, SoftBank, whose activity have become slower than what it was in 2021. And you would see a lot more investors ask about valuations and path to profitability, especially in the late stage.
All right. Also, your report points out that Bangalore has led the maximum total fundraise, followed by Delhi, NCR and Mumbai. So do you think this trend will continue? Will Bangalore continue to be the hub for startups in India?
So it looks like the case, and it looks like a lot of the activity, a lot of the new companies which are getting founded in Bangalore. You also saw a lot of the private market investors actually move to Bangalore in the past few years. So Bangalore continues to be a hub of activity. In addition to that, you also saw a lot of the tier 2 cities coming up because a lot of the people had started to work remotely and move to other cities. So this year, the subsequent year, you'll also see companies come up in the tier 2 cities also.
Okay, Neha, we've completely run out of time, but many thanks for taking us through the key highlights of your report. And once again, many thanks for joining us on Startup Street today.
Thanks for having me.
And moving on, in a world where shoppers are increasingly turning to their phones or laptops instead for stores for shopping, the decisions on inventory management, pricing, promotions, and a whole lot of other stuff has to be done through algorithms. That's where retail e-commerce management platform Commerce IQ comes in. It is working with brands like Kellogg's, Nestle, Colgate, and others in the US, and has more recently announced its entry into the India market. My colleague Ritu Singh caught up with Commerce IQ CEO and founder Guru Haran to understand the trends shaping the e-commerce scenario as we enter 2023, and began by asking him about their business model. Take a look.
If you look at total e-commerce in the US or in the world, it's a fast-growing portion of the economy, of the total percent of total retail that's happening.
Yeah.
Retail in the US is about $4 trillion. Out of that, $1 trillion happens on e-commerce channels. And if you extrapolate it overall in the world, 5 trillions transact today in e-commerce. And if you think about e-commerce in general, like pandemic gave it a nice boost to us. But however, most of that e-commerce is actually happening on retail e-commerce websites, like Amazon, Instacart, Kroger, and all those websites, as opposed to brand.com. Like we're not going to a Colgate.com to buy toothpaste anymore. We're going to an Amazon or Flipkart, an aggregator website or marketplaces, as they would call it. That is what is retail e-commerce. Now you have a lot of companies like, say, Shopify, who've been delivering a lot of really good platforms for brands to execute on their brand.coms. But what is the platform to execute on the retail e-commerce websites, the aggregators, the marketplaces? That's where Commerce IQ comes in. So in a way, we are the Shopify, but for the 85% of the market that happens on retail e-commerce websites.
So what is the work that Commerce IQ is doing back here in India? So I know you're working with a lot of large brands in the US, but India is more recent. Your entry here is only the last couple of years. What is the business here looking like? And especially after the pandemic, is the e-commerce wave sustaining, so to speak?
Up until last year, our presence in India was mostly an engineering and product team. So we are one of the few companies who are building everything. We are kind of the Make in India movement, but we started it way before. We are building all of that in India. However, our go-to-market has been predominantly United States. Most of our revenue was in United States until last year. This year, we entered India through a couple of acquisitions that we did. We acquired two companies, one in the digital shelf space, a company that's based out of UK, who serves a large portion of the global e-commerce, and also another company in Seattle in the US. And so based on with those, we've been able to develop a larger offering for the global markets. And right now we have presence in about 45 countries with over 440 retailers. You hear about quick commerce companies over here right now which are coming up, or even like, say, Flipkarts of the world and all that. We are currently supporting companies like Kimberly-Clark, or say Mars Wrigley, and other brands like that, to grow their presence in Indian e-commerce.
So how many brands are you working with currently in India, and how are you planning to grow that?
So globally, we work with about 4,000 brands.
Okay, 4,000.
4,000 brands. And in India itself, right now we're covering about a couple of hundred. We are nearing about 500, but that's a growth area for us.
You recently turned a unicorn earlier this year, thanks to that large fundraise from SoftBank. I just want to understand, are you using some of those funds to fuel expansion in markets like India through inorganic opportunities as well? Is there something on the anvil?
So M&A is a very key opportunity for us, and a key area of focus for us. In fact, we have a corporate development team right now, and we have weekly pipeline reviews of companies that we are looking at and all that. Mostly we're looking for companies in the marketplace on the retail e-commerce side of things.
Okay.
So if there is a company that is gaining momentum or is like looking to be a part of a big vision, we're definitely looking at those.
Is there a company that is on the radar?
So right now we have a pipeline, and there's about 2 or 3 companies we're looking at in APAC, not necessarily India, but things are changing so rapidly that we are, and our pipeline is still fast developing.
Earlier we were talking about whether the digital momentum that we saw during the pandemic has sustained. I also wanted to add to that and ask if inflation has further played a spoil sport, or how do you see the e-commerce market shaping up in India?
E-commerce during the pandemic had a pretty big step function because there was a massive movement with consumer shopping behavior. Now, during that time, most of the consumers started to shop online, and you had a massive insurgence into surge of the e-commerce channels. A lot of capital also flew in, came into that.
Easy money.
A lot of easy money available at that time, right? With the Fed rates being so low, a lot of foreign capital coming in, and so we were able to, there were a lot of investment that was happening. And that ended up sort of really over-capitalizing and having very high expectations on growth for a lot of the e-commerce, native e-commerce companies, if you may. Right? Now, during the pandemic, while that went up, there was an expectation post-pandemic that a certain amount of growth rate would have been sustained. But post-pandemic, what we have seen is that the growth rate has actually tapered down. But the good news, there's good news and bad news. The good news is that actually it's gone back to the pre-pandemic growth rates. Bad news is it's not sustaining at the highest levels that it was. And
but it's still growing, but at a slower pace.
So it's about a 15 to 16% CAGR, compounded annual growth rate that we're seeing in e-commerce, and that has sort of always been the case. But the capital that has come in has put a tremendous amount of pressure to sustain the growth rate, and that's what sort of has created a lot of that negative effect as you're seeing.
You know, let me zoom back into Commerce IQ again before we let you go. You know, you're present in various geographies as of now. India is one of, like I said, you've only entered or started acquiring clients in the last few years. What is the contribution in terms of your revenue mix that's coming from India, and are you looking at, it perhaps getting a larger market share, given that India is such a huge e-commerce market?
India has been always a very important market for our customers. In fact, whether you look at like global brands or whether it's, and hence us, it's India is a very fast emerging and one of the fastest or largest economies right now that's there. In fact, for FMCG markets, India is in the top 3 in terms of countries or the P&Ls. So through that, because of that nature, it also starts to become very important for us. Right now, we are supporting 4,000 brands on a global basis. However, we've always been traditionally a go-to-market has been in the United States. This year, we've done 2 acquisitions, and through that, we actually entered India as well. And right now, we're working with companies like, say, Kimberly-Clark, who manufactures Huggies diapers or Kleenex tissues and all those, or whether it's Mars, which manufactures pet food, to Mars Wrigley's and all that. So we have about a couple hundred brands who are actually currently using for their growth rate, whether it be on Amazon or Flipkart or even like quick commerce companies and websites that they have to manage at this point.
M&A, a key focus area for Commerce IQ, says the founder, Guru Hariharan. And on that note, it's time for us to head into a short break, but don't go anywhere. Coming up next on the show, AI and Robotics Foundation ArtPack has launched a $100 million venture fund along with AI Foundry to invest in early and growth stage AI and robotic startups. A special conversation with the CEO on the future roadmap. On the other side, stay tuned. Welcome back to Startup Street. AI and Robotics Foundation ArtPack has launched a $100 million venture fund along with AI Foundry to invest in early and growth stage AI and robotic startups. My colleague Aishwarya Anand caught up with ArtPack CEO Umakant Soni to find out how many such startups will it back and for what kind of products. Listen in.
$100 million is actually still a small amount because with AI and robotics, we're going to create $15.7 trillion of new economic value in 10 to 15 years time frame. So what we want to do with ArtPack is to actually stimulate this whole ecosystem around AI and robotics. Now we have got support from Ministry of Heavy Industries to set up an accelerator to create the critical manufacturing ecosystem for these kind of startups.
how will this seed the critical growth for an Atmanirbhar Bharat?
If I look at AI, right, we have talent, but we also need to set up this whole critical infrastructure around data. While we can say that we have data, but it is not in a usable format. So we are creating these gold standards data sets in Art Park. If I look at robotics, the critical infrastructure apart from talent is this whole ecosystem, right? So design for manufacturability. We need to have things which will work. So software and hardware have to work in sync, and then it has to have the intelligence loop built into that, right? It's very complex. That kind of talent is something that we are trying to not only nurture, but also grow in India. We feel that the next generation of companies, we call it AI first companies, they will come from India. I know for sure that Tesla, if I get it to Bangalore traffic, it will get stuck in Silk Board. But I know if there is an autonomous car that comes out of India, it will work in India, it will work in Southeast Asia, Middle East, Africa, as well as US and Europe.
All right. Now, apart from launching this VC fund, you're also going to support close to 52 AI and robotic startups in the next 5 years. So could you shed some light on those plans?
Absolutely. So we have this Startup at Art Park program, and this is primarily designed to create leapfrog AI and robotics companies. And the way we work is that if there is already a startup, they can come work with us. We have a program called Turbo, where we put in 100K or 75 lakhs into it up to. And the idea is to get them accelerated, not just with capital, but also with research.
One final question. Now, when you started out, you received a grant of $32 million from Department of Science and Technology and the Karnataka government, right? Tell me, as you scale and grow, would you be needing more capital in the future? And I mean, especially in 2023?
Absolutely. I think if I look at, you need 4 major things, right? You need data, talent, domain, research, and the critical aspect is all of this gets turbocharged with capital. So definitely 32 million is a great start. The idea is also to bring in private side of the funding as well.
It is Friday and it's time to see how the startup space has fared in terms of new deals this week. 16 deals took place valued at $320 million as per data from Venture Intelligence. Some of the notable deals include e-grocer Big Basket bagging $200 million from Tata Digital and others. HR tech company Better Place raised $40 million from Macquarie Capital. Jungle Ventures, British International Investment and others. Aqua Connect got $15 million from Low Capital, Omnivore Partners, Rebright Partners and others. And that's not all. College admissions enabler College Deco raised $9 million from Winter Capital. And poultry brand Eggos got $8.8 million from the likes of Ivy Cap Ventures, NAB Ventures and Avana Capital. Overall, the startup world has seen over 1,120 deals this year so far, valued at nearly $23.7 billion. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.